What's up, guys? How's it going? I'm back 2 days in a row, going strong. Today is Wednesday, August 13th, 2025, and I will be going over the profile for the day, the trade I took, and how I played it. It's going to be a shorter video, not going to do too much, so let's get straight into it. First, I was noticing that as we were going up, price was just going straight up. You know, it was a very clear move upside, and in a situation where we had resting liquidity that hadn't been swept in London, hadn't been swept in Asia session, which are these two boxes right here. This is Asia trading session. This is London trading session. This bigger white one that's hard to see is New York AM. This is New York PM. That's still going on. And those are called time-based liquidity. So the lows and highs of those sessions, those four, are the quarters, are more significant than just regular liquidity. So I had those labeled. Those were my draw on liquidity. That's where I expected price to go today. I had my standard deviation labeled. In this case, I had the first distribution move towards my target. Honestly, it could have been both. It really wasn't. I mean, this wasn't as accurate. It's not subjective. There's a science to it. And there's a reason why I chose this one, but it's really complicated, and it's not necessarily the point. And then here's another one that I used. This one was a little bit shorter term. This was a 5-minute leg, 5-minute move downwards that created an SMT. One thing that's very important to notice is SMT is always manipulation. Now, some of you don't know what manipulation is. Manipulation is when the price goes one way to fake out. It's a Judas swing. It's, faking out the people to buy here, sell here, so that they can get the liquidity in reverse and have the liquidity to reverse the opposite way. So in this case, we had the SMT, which I taught you yesterday. SMT is when, notice how the lowest low here is 730, which is lower than 645. But here, where is it? 645 is lower than 730. That's a SMT. Remember that, divergence, SMT divergence. So I placed my standard deviation on that because we always place it on manipulation or distribution. So I had an exact zone right here. I had a level which was right here. A level is just an exact price that I expected price to reject off of. I don't really like to play off of exact levels because it's very difficult to be exact with it, but I certainly keep them in my mind. So what was going on is the market was going up, opened, and 930, NASDAQ went up, but not anywhere near as much as ES, S&P 500, or anywhere near YM, the Dow Jones Index, went up. And so I was telling me there was a little bit of weakness in NQ, meaning that it had the most potential to go the furthest down, if I was right about this being a short day. Now, with all this liquidity, price at the beginning came down and made an SMT with these lows right here, where NQ didn't take them, where NQ didn't take these lows, but ES took all the pre-market lows, which drove price higher. But another thing that you should write down, if you're taking notes, which you should be, is SMTs, old SMTs, are draws on liquidity. It depends on the type of SMT, but a good amount of the time, once an SMT is formed, it pushes price in a direction, and then that SMT is liquidity that can be targeted in the future. So in this case, that's what I was doing. Notice my little label, that just means liquidity in my mind. So I was waiting for price to get to my zone, which eventually it did right here. And then you'll notice I have to go into replay mode to show, I think. Sorry, oh no, I don't. Okay, so here's what I was looking for. I noticed that we had a PSP, I keep pointing at my screen, 934. A PSP, remember, it closed downwards on NQ. But on ES, it closed, where is 34? It was over here. It also closed downwards on ES, but it closed upwards on YM. Remember, they're different. That's called a PSP, precision swing point. So my target and my entry was this candle, the 50%. If you'll notice, that's exactly where I bought, right here at 62.75, which was right here. Now, a lot of people will put their stop loss here, have a super tiny stop loss, and that's technically not a bad idea because we also had an SMT at these highs with some of this down here. So it's a good thought process to have that, okay, well, if this PSP doesn't hold, then I'm wrong. But on the other hand, I gave it 10 points of wiggle room just because I'm not always going to be totally right. And I really don't care about the flashy, tiny stop loss, high risk to reward. That doesn't mean anything to me. It shouldn't mean anything to you. The only thing that should mean anything to you is having a good enough wiggle room for price to fluctuate in case you're not perfectly right, because you're very, very infrequently going to be perfectly right. So in this case, technically my idea of rejecting off 50% was wrong, but I was right about the overall bias. And then once this candle right here was a PSP, we had continuing SMTs above this, and that was just confirmation. So I've moved my stop loss down just a little bit. So above that high, that's when I was like, okay, if it goes any higher, then I'm wrong. So I was minimizing my risk. I have a little turtle logo. It might be a little hard to see, but that's just, it's called a turtle soup. And I don't actually think that this is a turtle soup. Turtle soup is when an internal level, such as this one created right here, a short one or internal high, a recent high, gets swept, and then price goes above it, and then taps something far away to the left, whether it's high time frame, confluence, or liquidity, whatever it is, and price reverses. That's the most basic explanation I can. So yeah, technically it did a tiny little sweep and then it rejected, but it's not really a turtle soup. I just kind of put that there when I was trading. So I was in the trade, and I was on the 5 minute just watching it go. And right here I have a CISC, change in the state of delivery. That's when the downwards candles close below the last move of upwards candles. A lot of people have a difficulty understanding that. But notice 1, 2, 3 upwards candles, and then finally over here we close below them. Ignore this. It's not a part of, this isn't the highest point. It doesn't matter to me. But once this happens, that's changing the state of delivery. That's making price change its state of how it delivers. Does that make sense? It's kind of in the word. So once that happened, once I moved my stop loss right here, meaning I wasn't risking anything, I was playing with house money, if you understand, poker terms or whatever you want to call it. Meaning instead of risking 10 points, I was risking positive 2 points, meaning even if I was wrong and it went back to where I entered, I would still gain a tiny bit instead of losing. It's a way to protect. It's called risk management. It's the most important thing in the game. So it swept this liquidity. I was a little bit hesitant, but I realized that I knew I was right. I knew my draw was correct. And so I just held on, and I ended up closing just before these lows, again, because of the consistency rule. I reached the goal, passed the funded account. Let's go. So I will be trading real money from now on this account, but, well, kind of, but for basics of understanding. Just before these lows, because I knew it was going to sweep the lows, but I couldn't, take advantage of it because of the consistency rule. Now, here's one thing I wanted to point out in this video. If you notice, in last video, I talked about the hourly PSP. Now, in this case, you can see it absolutely got ran through, got completely disrespected. Where yesterday it bottom ticked perfectly. The reason for that is because this PSP didn't create an SMT with any quarters. So notice here, that's London low, this is New York low at the time, and it's the same here, and it's the same here, right? Whereas if we go back, remember this was the PSP right here. Let me just have it labeled so you guys can understand. Just like this. This was the low, 715-ish, was above London. But here, it was below London, meaning it created an SMT, a time-based SMT. It's called a SSMT for, if you're fancy. So that PSP wasn't as strong, and in my opinion, it wasn't valid because it didn't go with my bias. So this is the most important thing, and this is very important, especially for you traders who have been trading for a long time. An A+ setup is not the most confluences or the best entry. That's not what an A+ setup is. An A+ setup is a setup that has everything and goes with your bias. This could have been an A+ setup where price did everything I wanted it to, but if it went against my bias on the longer term, it's not an A+ setup. It could have perfect confluences, but if it doesn't have the high time frame, it's not an A+ setup. So obviously I was in shorts, and I had these labeled. I really didn't think we were going to get this low. My bias was actually down to, was down to the 4 hour for value gap, which it did get down to. But I was expecting maybe right here a bit more of a retracement. But as you can see, it's just the basics. It returned. Oh, it actually, I don't believe it tapped. No, it didn't. Didn't tap the hourly for value gap. Tapped the 4 hour. It's rejecting. It's creating some liquidity for tomorrow that can be swept. This is all accumulation. It's accumulating liquidity at the top and at the bottom. So once one side gets swept, let's say it, messes around a little bit. Once it goes down here, it's highly likely to return to the top because there's just a lot of liquidity that the market needs to sweep. So that's kind of it for this video. I'm not going to go too in depth in anything. My goal, and I'll probably be doing this on weekends when I don't have a market to review, I will be going over specific things. I'm going to do a video explaining what a funded account is, the parameters, everything, because a lot of people struggle with understanding that when they first get into trading, and don't understand how am I risking this much? I can explain that. And then I'm going to get into the basics like liquidity, or my favorite, and in my opinion, the most important, market maker models. Now, and this is, in my opinion, the most important confluence to understand. This is how I form my bias. This is how I get all my ideas. So yeah. As you can see, this is a level of accuracy that you shouldn't try and replicate. This is all-time highs. This is the highest point in the market, and I shorted it to the exact minute. You shouldn't be doing that. That shouldn't be anyone's goal. I've been doing this for years. I have experience, and I'm just showing you what I see so that you can adapt and get motivated. But this is a completely unrealistic standard to hold for yourself, and a completely unrealistic goal for at least a year plus. So, good for me for making this trade. But even if I got in down here at this retracement, I still would have made plenty of money. And so would you have. So don't try and be me. Don't try and compare yourself to all the TikTok traders, none of that. Just stay in your own lane, focus on you, and you'll figure it out. So, transition. So that's going to conclude this video. I hope you guys enjoyed. I will be back tomorrow telling you the streak is not going to stop. Hit the like button, subscribe, comment what you'd like to see. If you have any specific questions, I will answer questions in the comments. Have a great rest of your day. Catch y'all.